So this is absolutely phenomenal, team, and if we continue on at this rate, we could very realistically be looking at maybe 150 to 200% annual return, risking no more than 0.25% per position. So good morning, ladies and gentlemen. It's Max Norbury here from the UTC, proudly bringing you the market analysis report weekly preview video. I do apologize I didn't get it out yesterday. I had an absolutely manic day yesterday getting everything prepared for the rest of the week, and so therefore I've been a little bit slow and a day behind on this one. But without any further ado, let's get going on. So first of all, guys, last week was absolutely freaking insane. We had a 7.71% realized growth. That's a net return to our funds portfolio. Frankly, absolutely astronomical. Bear in mind, again, I never ever risk any more than 0.25% of my account. Okay. Now, when obviously you're trading in large volumes, it's a lot of money still, but we've been doing that since 100K. Okay, and we're now well over 1 million. So it just goes to show you don't need to risk a lot in the markets, and every single one of these positions has been provided to our community members every single step of the way. Not a single one has been left out. So if you join, you can tap into that. You can gain access to that fully transparent, exactly the way it should be. Now, last week, again, was absolutely brilliant. I've written down here, UTC funds soared plus 7.71% in what we believe is a record-breaking week of performance with a strong grip on current macro context and technical setups. Now, there's a lot going on out there at the moment with geopolitics, with the econ. There's a lot of different spinning plates. You do have to have a bit of a grip on it in order to be able to perform at that level, for sure. But it's absolutely doable, and it's really quite an interesting time to get into the markets if you already have been for a couple of years. Really good learning process at the moment, and it's definitely good for you guys out there who are sort of taking those next steps to becoming a trader. Now, in terms of the weekly return, as you can see down here, we got a 1.6% Monday, Tuesday coming in around 2.3, Wednesday was just over 1, about 1.1, 1.2%. Thursday killed it again at 2% plus. We had maybe 2.1, and then on Friday a very modest return of around a 0.4% return on Friday, and that was from the US Open. So again, absolutely killing it every single day on day, and this doesn't happen every single week. Okay, it's quite a big deal, as you can probably tell from the way I'm expressing it. Now, this is the interesting one. Okay, down here, portfolio metrics. So this is just the annual data. Okay, this is from Jan to Jan, and this is throughout 2025 so far. So far this year, we have done 90.3% annual return. We are in July. The day's date is the 15th of July. We've still got a couple of weeks of July to go, and then of course we have the latter 6 months of the year. So this is absolutely phenomenal, team, and if we continue on at this rate, we could very realistically be looking at maybe 150 to 200% annual return, risking no more than 0.25% per position. So look, anyone out there who's saying risk 2% per trade or more, go down a casino. Okay, your lottery ticket winners, there's no doubt about it. The risk of ruin over here, which is the RR, this is the most important metric that you want to be looking at on the screen right now. That stays at 0%. It stays at 0% because there is a 0% chance that I am going to blow my account, and that is and has remained the same forever, always. Okay, very important metric, that one. Now, the total risk reward over the total portion of annual trades this year is at 2.9%, so very healthy. That is a standard professional prop desk, CBOT prop desk. That's what they would look for. We've got a monthly average return of 12.9%. Obviously, that is taken the average. I've not done 13% every single month with the members here. Some months have been a lot lower. Some months have been a lot higher. So it's kind of peaks and troughs there, but that's the average. And then the weekly average is at 3.2% every single week. So very, very healthy metrics so far this year. And then down here we've got, this is trading volume, longs versus short trading volume. At the moment, surprisingly, we've actually got a lot more short exposure than we did long so far in July. It'll be interesting to see which way that goes as we continue on. And then finally, we finish up here with the ratio comparison. This is a standard benchmark in practice used by all professional funds out there. Measure our performance gain versus the S&P and the UK FTSE, just as an average European index there. UK FTSE actually had a really strong week last week, coming in at plus 2.65%, as you can see there. The S&P was down actually minus 1.45% at the end of the week. QTCF returned 7.71. So I mean, it kind of explains itself there on that one. No need to go over it again. Now this week, in terms of market trends and opportunities, ladies and gents, we've got some pretty decent stuff in the tank for you. The NAS 100, Aussie NZD, UK Brent and gold. Now all four of these at the moment are looking at contractionary cycles this week. So I'm not actually looking at too much bullish continuation. I'm looking at those counter trend plays. So the NAS 100, for example, looking at the breakdown of structure back into liquidity so it can fuel up for that next leg up. We've got the Aussie NZD over here as well. Very similar practice. We've had a really nice bullish run. We've got a lot coming out from the RBA and the RBNZ at the moment. I think that's going to fuel the sort of mean reversion of this before the next leg comes into play, just from the macro technical setup there. So that one, I think, is going to be coming back down for a price action pullback first, followed by that second leg up. We come down here, we've got UK Brent at the moment in a nice 4-hour channel. At the moment, we're trading in the median of the channel, but I do believe that we're going to see the break of the lower limit of the median and then a push back down to the lower limit. And that essentially means that price drops from here down to there, and then trend continues, and the trend will continue through the liquidity, because we are actually trading beneath it at the moment on the daily time frame. We don't want to ever be trading towards commercial liquidity. We want to be trading away from those pockets of commercial liquidity. That's with the commercial move. Okay, and that's what we do here. And then finally, with gold over here at the moment, we've got a really nice bit of range in volatile market state structure. We are trading at the median of that range at the moment, but I think a continuation back up to the previous highs probably likely, and then we get the push back down again. I think we're definitely building up for that run up to 4K, right? So I think this continues. CPI week this week, CPI, PPI, geopolitical plays. We've still got trade tensions going on at the moment. We have an August 1st date for the tariffs, trade wars. That's going to create safe haven, a safe haven necessity and in market sentiment. So there's a lot, like I said, there's a lot of spinning plates at the moment. We need to stay balanced. We need to stay sort of with process. And looking at gold and the technical setup at the moment, I don't see any reason why it wouldn't continue to range. There's no reason for it to break out and provide the positive and balance of price that we're ultimately looking for. So as we go down here, we dig into some more of the econ stuff. So market challenges at the moment. So this is a model that I've personally created over a number of years. It sucks in all of the economic data and provides projections, forecasts, and impact scale to the exposure of the portfolio. And so therefore it's handy for you guys because I'm providing the portfolio exposure for you. So looking at the market challenges this week in terms of what we actually have going on in terms of the 4 primary watch list in the market report. The market challenges is saying that US inflation data, PPI data, and retail sales is what's going to be driving these 4 particular assets the most out of everything that's going on this week. So for example, it's saying that the US inflation data is going to be quite hawkish for the FX markets but dovish for stocks. It's going to be quite hawkish for FX markets and the PPI, but it's going to be dovish for stocks. And then it's saying that there's a neutral price bias really for US retail sales. It's only registering a 3 out of 10 in the impact, so probably not going to get too much of a volatility strike from that one. But we do have a 9 out of 10 and a 5 out of 10 for the US inflation data and the PPI data. Just to confirm, the US inflation data does count core and base inflation as well. So looking down here at the state structure volatility index, this is all commercial liquidity long versus short. Some wild numbers this week, team. I've got to say, I mean, Aussie NZD 68.21, NAS 100 35.44% of commercial liquidity is long. I mean, that's a lot of shorts in the NAS 100 at the moment, but ties in really nicely to our setup. So I think that's going to be a decent player this week. VIX at 40%, UK Brent 59.53. Those two I'm not really too surprised about, is what it is. And then we've got gold, it's 71.05%, which is, I mean, that's crazy. That's a lot of long liquidity. A lot of long liquidity in gold at the moment. So be really interesting to see what the next few weeks are like for the gold shiny stuff. And then we come to the Economic and Order Book Impact Report. Now this covers off a lot of intense commercial data and puts it into bite-sized chunks that everybody is going to be able to hopefully easily understand. So first of all, we're going to look at the Economic Impact Scale, and this is really a clever piece of kit, proprietary, owned by the UTG. US core inflation data is registering as a 9 out of 10. US base inflation is a 7 out of 10, so we're looking at more impact in terms of broad market scale impact in the core than we are the base. CAD inflation and UK inflation rates only registering as a 3 out of 10 this week. If they've made it onto the scale, it will move the market, but a 3 out of 10 is not going to move the market much, okay? In terms of US PPI, that's registering as a 5 out of 10, UK unemployment rate at a 2, and retail sales registering as a 1 out of 10 on the impact scale. So you might get a 15-minute blip, for example, from that US retail sales data. So as we move down then into the impact gauge, this is basically saying, okay, this is all of the economic data coming out this week. Which asset class is it going to most significantly affect? So as you can see here, Forex is at 75% at the forefront of the impact from the economic data. Stocks, equities, indices equities, both 10%, with commodities dragging behind at 5%. So in terms of where your money's going to be safe in terms of market volatility, the FX market this week might be a little bit of a minefield. You want to be well aware of that. You need to use that. It's a very, very important indicator. Now we're coming over here to the money flow trends. This is total liquidity, total registered liquidity in the financial markets. And this is why the numbers are pretty balanced. Okay, so commodities, currencies, indices, 50.2% long versus short, 52% long versus short, and 54.38% bought. Okay, long versus short. It's nothing surprising about these. Unless you get some outliers you can action, generally speaking, these numbers will be relatively balanced. So for the time being, that's absolutely fine. It falls right within the parameters that I've set out for there, being any alarm bells, for example. So for those of you who are equity junkies out there, I do focus on the equities as well. I have a very decent equity portfolio with IBKR that I've managed for the last 9 years. And equities is a big thing. We don't really cover it too much day to day. There's not always a lot to cover, but we do cover it every single week in the market analysis report. I have a couple of picks here, the four interesting picks, and I have a personal spotlight equity of the week. This week, it's not too exciting. I don't tend to like AAA mainstream stocks. It's not the kind of trader that I am. I really like my niche small cap stocks. I like big moves. I like in and out of the market. Not too much of a buy and a hold kind of guy. But Tesla this week, it just has some really good data and it's got a really decent setup, so I couldn't not post it. It's a decent setup, and now that you can get fractional shares on most easy platforms, there's no reason not to list it. So there it is. And then finally, we have the institutional buying interest by sector, and this is a measurement of hedge funds' strategic positioning in each individual sector. Technology leading the way, as it usually does, but the one that I'm most interested in out of all of these is the energies, guys. The energies has been in the top 4 for the last maybe, I don't know, 3 to 5 months. At the moment, there's a lot of interesting things happening in the energy space at the moment, and I definitely think you should start taking it seriously and getting involved in that one. So as always, this information provided in this market analysis report is purely for informational and educational purposes only. This is not financial advice and should not be considered as such. Basically, trading's a bloody risky game. You guys know it. I know it. We all know it. We're all well aware. So there we are. So that's pretty much it. So I'm going to flash over to the FX space now here, team. Just give you a quick rundown of what happened yesterday inside the trading room. We actually had a really good day yesterday in terms of our US breakout. Now on a Monday, we only trade the US markets, the European markets as well from time to time, but we only focus on trading stock breakouts, right? We don't focus on building out our order book in the FX space, the metals, the energies, and the rest of it. We only ever focus really on the indices. But it was a really, really good turnout yesterday. So I provided a bunch of forecasting for the afternoon, sent the explicit trades out to all of our community members, and the results were pretty good. Get off the ground for a Monday. We had a 1 to 2.36 launched in the Dow Jones. That did a net return of around 0.56%. So that was great. We had the NAS 100 over here as well. Very similar trade, which was this one, which was via the breaker structure after the break close and retest of the structural point. This one yielded a 1 to 2.16. Net return was a 0.51%. So that's now over 1% to get the week off to a good start. And then we did actually take a little bit of a hit in the S&P yesterday. Of course, 0.25%, so never too much. But we did lose a 0.25% trade in the S&P 500 yesterday, following a bear breakout trade that I assumed was going to be running back down to the base of operations at 62.40. So we had minus 0.25% on that one, plus 0.51% on the NAS 100, and plus 0.56% on the US 30 Dow Jones. This leads to around a daily gain of around 0.8% up for the Monday, and we've still got all week to go. So not bad at all. So I'm going to wrap things up there, ladies and gentlemen. I hope you've enjoyed this market analysis weekly preview. And remember, you can get that report every single Monday entirely for free. All you need to do is join the trading room. You can join as a basic tiered member. You can go to www.utc.com/pricing-plans. You click on the UTC Basic, you can join as a free member and gain access to that market analysis support every single week. Plus, every single Wednesday, you will see me come on live for a particular show as well. So I'm going to wrap things up there, ladies and gents. I hope you've enjoyed this session. Don't forget to like this video and subscribe to the channel and help us get on our way. Take care, good luck, trade safe, and I'll see you then. Bye-bye.